The macroeconomic highlight of the coming week is likely to be the first meeting in 2022 of the US Federal Reserve's Federal Open Markets Committee, or FOMC. The equivalent of the Bank of England's Monetary Policy Committee, the FOMC will meet on the 25th and 26th of January, and on the latter date, Chair Jay Powell will announce its latest decision on both interest rates and quantitative easing, or QE. Now, the Fed's tune changed a lot in the second half of 2021, as it went from inflation was not an issue to it being maybe transitory to actually, yes, it's a potential problem. As a result, the Fed began to reduce the amount of monthly QE, or monetary stimulus, from its peak of $120 billion a month. First of all, it began to trim that back by $15 billion a month, and then at December's meeting, it moved to trim that back by $30 billion a month. This means that the Fed's $8.9 trillion balance sheet should stop expanding in March, and Mr. Powell has already begun to hint that QE could be replaced by QT this year, or quantitative tightening, whereby the central bank does not reinvest as its bond holdings mature, its balance sheet starts to shrink, and it actually begins to withdraw monetary stimulus. Now, in terms of interest rates, the current headline is 0.25%, back at all-time lows. But as last year progressed, Mr. Powell's and investors' expectations moved from no rate rises in 2022 to 1, then 3, maybe even more. According to the CME FedWatch website, there's just a 6% chance of a rate rise at the January meeting. But by March, the market's pricing in a 97% chance of an increase, with a 5% chance of a half-point raise rather than the customary 1 quarter. And by the 8th and final FOMC meeting of the year on December 14th, 3 rate rises of 0.25% each up to 1% is the consensus view. Note that there's 0 probability put on no change at all this year, an 11% chance put on 6 rate rises or more. On the corporate front, results season is picking up pace in Europe and hitting top gear in America. It's not scheduled to be quite so fast and furious here in the UK, but there is still a strong slate of scheduled trading updates and first half and full year results, including those from half a dozen FTSE 100 firms. Names which may be worthy of further research include the following, although again do please note that these dates could yet be subject to change at short notice. Computer Centre on Monday the 24th of January, SureServe on the 25th, Fresnillo, Sage, Wizz Air and Pets at Home on the 26th, 3i, Saga, Britvic, Dr. Martens and Polymetal on the 27th, before Airtel Africa and ITM Power close out the week on Friday the 28th of January. But the company which could just cause the biggest fuss in the week ahead is Diageo, the global drinks giant, perhaps best known for its Johnnie Walker and Talisker Scotch whiskies, Captain Morgan rum, Smirnoff vodka and Guinness, is due to report its first half results to the end of December on Thursday the 27th. Now, the shares are up by nearly 30% over the last year, helped no doubt by vaccination programmes and end to lockdowns, at least in most parts of the world, and if only to varying degrees, and also a global economic upturn. The company's brands may also offer it some protection against input cost inflation thanks to the pricing power that they bring, although the shares have nevertheless dipped a little bit of late. That may reflect the threat of higher interest rates and a potential shift in market sentiment away from reliable, consistent companies like Diageo, whose shares carry a premium valuation, and towards cyclical companies, players where there's rapid profits growth, albeit from a low base, and that might be able to come through and do so from lower valuations if, and I stress if, the global recovery keeps going and inflation stays relatively high. Analysts will look for comments on cost price inflation and pricing from the company, but before they do that, they'll probably move to assess 3 headline figures first. The first one of those is organic growth, so they can check out underlying sales progress, excluding currency movements and acquisitions. In the fiscal year that ended in June 2021, organic sales were up 16% and volumes were up 10%, as demand recovered from 2020's harsher viral variants and lockdowns. Compared to 2019, perhaps more interestingly, sales grew 6% on an organic basis. Now, on a headline stated basis, the consensus analyst forecast for the first half of this year is £7.7 billion against £6.9 billion a year ago. That's a year-on-year increase of 11%. The second headline number is pre-tax profit. For the full year, analysts are expecting a 16% increase to £4.3 billion, although for the first half, they're looking for something a little bit more moderate, 8% to £2.4 billion, as the second half comparison is much softer. Finally, attention will switch to the dividend. Diageo raised its dividend by 4% last year to extend an annual growth streak that began in 1999, and analysts have penciled in a 5% increase for this financial year that ends in June. That growth rate provides a benchmark for the first half, when Diageo paid 27.96 pence a share a year ago. Diageo is also running a share buyback programme, by the way. In 2019, it announced it would return £4.5 billion to shareholders via this mechanism by 2024. It had bought back £1.5 billion by January 2020. It revived the plan in early 2021, £450 million worth of shares, and then launching a second leg with a plan to buy another £550 million between November of last year and March of this. Analysts will no doubt look for any indication of how the remaining £2 billion will be spread across 2022, 23 and 24. And they'll also look to Chief Executive Ivan Menezes for any financial guidance for the rest of the year to June 22. No doubt Diageo at least is looking forward to the return of duty-free shopping if and when international travel recovers. I hope that you and your families are all in good spirits and keeping well. Thank you for watching, and I look forward to seeing you next time.